Good evening, everyone. Marty Missouri here, February 2nd, 2017. This weekly video, we're going to talk about the economy, global markets, and then we'll finish up with a look at the S&P 500, the U.S. market. In front of you is the Citigroup surprise indexes for the U.S., Eurozone, Japan, China, and emerging markets. The line rises above zero. That tells us that the actual economic data, as it's reported, exceeds the expectations of the consensus of economists. As you can see in the U.S., from about mid last year, the economy has been doing better solidly than what economists had expected. You can see the same in the Eurozone, better yet from the beginning of 2016. Japan is hanging in there, did dip a little bit below, but lately, in fact, last night there was some very good data out of Japan. It's outperforming the consensus. China is as well, and certainly the emerging market complex has been doing better than economists expected in a really big way. If you look back here, folks, I ran a 5-year chart. You can see for much of the last 5 years, the economy was actually underperforming what economists had expected, or I should say economists were expecting more out of the economy or economies of the world than we were actually seeing. And ironically, in the US, this period here where we were pretty much hugging the zero line, this was a period where stocks were basically flat as a pancake. I've shown you numerous times that consolidation box that just recently we looked to have broken out of. So while economies and markets don't always move in the same direction, what we want to look at here is the probabilities for what really creates big bad bear markets, and those are recessions. And right now, the economic data throughout the world pretty much is telling us that we don't have a global recession looming, despite some of the concerns that we keep hearing about out there. So what about the markets of the world? Now, I have been preaching for quite some time that the setup for non-US, believe it or not, actually looked better to me than the setup for the US, and we even increased our target allocations just a smidge to the non-US exposure. And so you have the S&P 500 in front of you on a year-to-date basis. This is the Europe Stocks 50 index, or this is the ETF that tracks that. A lot of our portfolios own some of this. As you can see, it's been doing just a little better as of right now, 1.97%, call it 2% year-to-date versus 1.8 for the S&P. As you can see for the month through the 25th, it was doing much better, but we've had a bit of a sell-off here of late. Japan is having a very good start to the year, up 4% on a year-to-date basis. China, believe it or not, is having a huge start to the year, up 7.5 for this ETF that tracks China, I should say. The emerging markets in the aggregate, very good start to the year, up 6.7%. And then Europe, Australia, or Australasia, and the Far East, the EFA ETF, which is in just about every one of our portfolios, is up 3.79. So developed non-US markets are performing about 2 to 1 better than the S&P 500 so far this year. And again, this is something that I think we should anticipate when we look at relative valuations, stage of the economic cycle, and so forth. So sometimes, folks, the news is inconsistent with what's really happening under the surface. So the market tells stories, and the story that the markets are telling us right now is that we absolutely want to hang on to our non-US exposure, if not enhance it a bit, and expect better things going forward. Of course, the future remains to be seen. Taking a look at just the U.S. market, the S&P 500 index, weekly trend is very much intact. There's a trend line that starts in February at the low, goes through Brexit, and continues to slope upward. 26-week moving average looks good. On balance volume on a weekly basis looks okay. That moving average convergence divergence that I keep pulling out is very positively sloped. But what about on a short-term basis? People seem to be concerned lately with the short term. I have traders who ask me what I think. Should they be shorting the market and so forth? Well, I'm kind of a trend follower, and if I were a short-term trader, I wouldn't bet against the longer-term trend, as I just showed you in the weekly. But some folks do, swing traders do, and so forth. So let's look at why somebody might be a little bearish on the near term. And actually, I now have a couple of signals that suggest maybe they should be. I drew these trend lines that basically capture a shorter term trend. And this looks like an upward sloping wedge to me. In fact, I think that's what it is. Now, markets tend to break below the upward sloping wedge somewhere halfway to 2/3 of the way through it, and they often come back to about where the upward sloping wedge began, which would be about 2234 on the S&P. That looks like about 46 points, 45 points, a little less than 2% on the Dow. That would be about 360, 370 points from here. That would just be well within the realm of normal, kind of easy not even corrections, but pullbacks or drawdowns in a healthy uptrend. So certainly here, we're not worried about that. But if I were a short-term trader, this would embolden me if I were looking to go short the market. The other one here is that MACD on a short-term basis. On my weekly message last week, I said that that was a buy signal. Well, and I said, but short-term traders check back tomorrow. Well, check back 3 days later, and now it's morphed into a short-term sell signal. So that would tell traders to look for some downside action perhaps. But you see, we had one of those here, and we did see a little bit of a sell-off, but certainly wasn't much before the market started marching again. And here we had one, and you might have made some money on the short side, but you should not have stayed there very long as the market came marching back up once again. So folks, what I'm telling the rest of you out there who aren't short-term traders is just expect volatility in this market. As you've noticed in the headlines, there's a lot of uncertainties out there, things that concern me like protectionism, things like perhaps deregulation and a better corporate tax structure would be very market friendly. Right now, clearly, the data and the charts are telling me that we're in a bull market and the trend is pretty solid. Next week when I talk to you, it could change. But again, remember, we're long-term investors, we're asset allocators, and we pay a lot of attention to sectors. And I've been showing you a lot of data lately that suggests that we should be in the cyclical sectors because they're telling us right now that the economy is getting better, not worse. Thank you, folks, as always, for watching and listening. And look in the next 2 or 3 days for my weekly message. Take care.